This is Fintech Insider News. This week, Capital One buys Brex, JPMorgan buys WealthOS, and Vennre has raised $9.6 million, and its CEO is here to tell us more about it. We'll be tackling all of this and more on today's news show.
When you want your spring break to feel like... and your kids' pool day to feel like... and your hotel bed to feel like... ooh, and room service to feel like... because at Hilton, hospitality feels like...
Your cabana's ready. Would you like fresh towels?
it matters where you stay. Book now at Hilton.com. Hilton, for the stay.
Hello and welcome to episode 1034 of Fintech Insider News, brought to you by 11FS, 5-time consultancy of the year that works with financial services providers, big and small, to build the next generation of financial services. I'm Benjamin Ensor, Director of Research and Strategy. It's never a slow week in fintech, and this week is no exception. So to help me unpack the stories of the week, I'm joined by a brilliant panel of guests. First of all, I'm delighted that we have a return to the show for Ziad Mabsout, co-founder and chief executive of Vennre. Welcome back to the show, Ziad. You've got some exciting news, which we're obviously going to get into a little bit later on. But can you tell our listeners a little bit about you and a little bit about Vennre, please?
Sure. Thank you very much, Benjamin, and very, very pleased and delighted to be joining this panel. So Vennre is a wealth creation platform that is addressing the gap for Henrys, high earners, not rich yet, specifically in the MENA region, and with a more focused area on the GCC, especially Henrys that want Sharia-compliant investments. So this is our mission. Our mission is to allow them to have a stable wealth journey and a growing wealth journey. And we started by offering curated and vetted private market opportunities.
Fantastic. Well, welcome back.
Thank you very much.
And we have another Fintech Insider return for our second guest. And honestly, it feels a little bit odd to be welcoming her to the podcast because Sarah is, of course, a former podcast host. But Sarah, can you perhaps introduce yourself to people who've only started listening to the podcast more recently and perhaps don't know who you are and what you do?
Thank you very much, Benjamin. It's always a pleasure to be back. And I have to say, it's always a pleasure to be this side of the microphone answering the questions rather than asking them, because I think people don't quite appreciate how difficult it is to host a podcast. So thank you. Thank you for letting me sit this side today, guys. So my name is Sarah Kocianski. I'm an independent fintech consultant or advisor, and I work with financial services companies, large and small, helping them understand the markets in which they operate and the best way to capitalize on the opportunities for them there.
Thank you. Welcome. And I'm also delighted to welcome another guest back to the podcast, Matthew Ford, Chief Executive and co-founder of Sidekick. Welcome back. Again, for listeners who perhaps aren't aware of Sidekick, could you give us a quick introduction to who you are and what Sidekick does, please?
Absolutely. Great to be back. And I didn't realize I was on the easier side of the table, but that sounds great. I'm Matt. I'm founder and CEO of Sidekick. We are a digital private wealth platform aiming to open up a lot of those opportunities that have been locked away for high net worth investors and make them more accessible to a wider mass affluent audience. So think about some of those financial advantages like access to Lombard lending, to personalized portfolios, to private markets. So yeah, I'm sure we're coming from a very, very similar space on that. How can we digitize those, open them up and make them more accessible for people?
Wonderful. Welcome. So we have a panel, so let's get on with the show. So the big story of the week, or the biggest story of the week, is that Capital One has acquired Brex for $5.15 billion. So the American credit card issuer Capital One is to acquire commercial finance platform Brex in a deal for $5.15 billion. The deal, which is set to be concluded by the middle of this year, will see Capital One pay for Brex in shares and cash and bolster its financial offering for corporates. Richard Fairbank, the founder, chairman and chief executive of Capital One, said his firm's acquisition of Brex would accelerate its long-time ambition of becoming a payments company at the frontier of the technology revolution. Pedro Franceschi, founder and chief executive of Brex, hopes to build on this success by partnering with Capital One and continuing to lead his company once the acquisition is finalized. Sarah, you were very quick on this to start sort of talking about this. What was your first reaction? Were you surprised by the news? Do you think this is good outcome for Brex, good outcome for Capital One, good outcome for both? What do you think?
Yeah, no, I think it was. It took me by surprise. Certainly, it may have other people closer to it may have been less surprised. Certainly, I think it's a signal of kind of one of the largest acquisitions, if not the largest acquisition we've seen between a bank and a fintech in recent years, if not of all time. So, very interesting story. From my perspective, I think it's actually a win-win on both sides. Its nearest competitor, Ramp, is outperforming it, which means Brex is probably looking to look for an exit for itself. Not least the fact that it has spent quite a bit of time in the last 3 to 4 years repositioning itself. So in 2022, it let go quite a few of its smaller customers, some of its startup customers, in order to focus on more established customers, i.e., a focus on profitability. It would appear that has worked in that. TikTok and Robinhood are reportedly customers of it. I used the word reportedly there. I wasn't able to find anybody to corroborate that source. But my point here is that, Brex has done good. It's worked its way through the pandemic. It's worked its way through some repositioning. And it's now ready for, founders to move on to something else. Some people have made quite a big deal about the fact that this, 5.1 billion is down from, 12 billion valuation a few years ago. I think that's a complete distraction. I remember talking back in 2021 about Stripe's valuation going from 95 billion to 50 billion, and it hasn't done them any harm. So I think what's more important there is to look at the kind of the corrections in the market, but also, and somebody who has better head for numbers than me has done some analysis here and shown that there's still about $3.6 billion going to equity holders. So Ziad may have different opinions as founders of startups, but I think it's a pretty good deal for Brex given what they've been through in the last few years. Capital One, I think, is, there's a number of reasons why it's done it. I'm sure we'll go into those later. But, there's a couple of things there. If you get customers like TikTok and Robinhood on your books, that's always going to look good. If you're a big bank trying to reposition yourself as somebody, modern and relevant, Brex just did a real load of work to get a license to operate across Europe more broadly. That's really good for Capital One as well, which sort of has a slight base in the UK, but certainly nowhere near the presence it has in the US. So all that's to say, I think it's a good deal on both sides. I'm sure I'm going to pause there and we'll pick it up later. I think what happens next is going to be very important, and how everybody behaves next is going to be very important. But for the initial news, good news on both sides.
5 billion is certainly a big number. Ziad and Matt.
Yeah, I wouldn't say no. I wouldn't say no, is all I'm saying over here.
Ziad and Matt, I'd like to bring you both in as founders. Maybe let's start with you, Ziad. I mean, is this good news from a founder's perspective, selling to a bank? What do you think the sort of employees might be thinking? Are the employees going to be excited? This is a new chapter. Are they going to be a bit daunted? What would you be thinking about if you were in these shoes?
Yeah, sure. Look, actually, it might be surprising, but I follow what Sarah said, and I'm as well. If we want to look at it from practical perspective, I think I spent 10 years on my of my career on the buy side, and if I learned anything, that it's not enough to learn how to buy. It is as well to learn when to sell. And I think, honestly speaking, it needs a lot of maturity to make such a decision. It needs a lot of conviction, realization. In general, not necessarily every startup or fintech will grow to be independent. It is not a harm if it was acquired. I think the challenge is what happens if there is a big gap in the DNA. There is a big gap in how things are done. Will that stop the innovation? Will that stop their speed? Or it will really unlock? Matt and I are in the field of fintech, or more precisely wealth tech. Regulation is something very critical. It can bound you from moving a lot. So it's not a matter just of tech innovation. Regulation is something very, very important. It can stop the nicest features and ideas and ambitious. So overall, yes, the kind of what is bittersweet is that it's below their latest valuation. But that's an acquisition. That's a cash acquisition, including shares, but it is an acquisition. Someone is taking money out from their balance sheet to pay it to investors and employees and shareholders of Brex. So, to be honest, I don't think it's a bad deal. Maybe they caught they made the right call on the timing.
Thank you. What was your take, Matt? Do you agree?
Yeah, I mean, I think it's sign of the times as well. If you think about, I mean, their big funding round and high valuation was 2022, and I think we all know what was happening then, which was valuations that decorrelated from reality. So, like, I don't think looking at Brex in isolation on that is a particularly helpful thing. I think if we have a look at the whole of the fintech and all of the startup ecosystem around that time, there was a lot of overinflation at that point. So I think kind of valuation-wise, sign of the times. I mean, the other side of it is just like the path to liquidity is hard now. So if you look back 10, 15 years ago, speak to any founder that's trying to build a unicorn, all they're talking about is an IPO. But I mean, public markets or IPO listings have dried up, as we know. It's kind of boosting a little bit, but that path is not the same. 22, 23, there were SPACs, and and that was the alternative route of getting cash out. But it is really hard, and trade buys seem to be the most obvious liquidity event ultimately. And if you've been a company that's had funding for 10 years, you've got institutional backers, there are requirements to get some cash out. So whether that's secondaries or whatever it may be. So I'm sure they were feeling the pressure to get some liquidity coming out, and I think a trade buyer was ultimately the most sensible. Whether it's a good deal is always an interesting question, because looking from the outside, it's very easy to go big numbers. But as every founder will tell you, the devil is in the detail. It completely depends on what stack they have, what the liquidity preferences were like, what nasties were in those terms. So I'm sure I haven't dug into the complexities of the deal, but I'd love to have a look at how many employees walked away with what the founders took away, whether it was actually the last money in that took most of those returns out. That for me is whether it's a good deal or not, rather than just the absolute number that's often kind of just shouted at the sale.
Indeed, that would be very interesting. Some very interesting thoughts there. And SPACs are special purpose acquisition companies, for anyone thinking that Matt was talking about some new type of footwear. Sarah, what about the acquirer here? Because it's easy to look at this and say, oh, okay, it's just another big bank and so on. But actually, of course, Capital One isn't just another big bank. In fact, it's not really a big bank at all. It's a credit card issuer. And Capital One, of course, was a fintech or a startup itself within living memory. It's only founded in 1994. And I know we've got some listeners who are younger than that, but it's not that old. Is it significant that this is Capital One that's buying it? And do we think that Capital One's culture might be better placed to absorb and embrace a fintech like Brex than perhaps some more established, more traditional, more older banks?
Yeah, certainly, something has been made on social media, and there've been an awful lot of kind of thought leadership pieces on this acquisition out there. But certainly something's been made of the fact that Capital One is still run by its founder, Richard Fairbank, who is the founder, chairman, and chief executive of Capital One, according to the notes here, which sounds like an awful lot of jobs to be doing at once. But that's a whole other cultural question. But it suggests that there might be some synergies between the founder that said they wanted to stay on and the guy who basically has bought his organization. Because I think a lot of the times when you see fintechs acquired by large financial services organizations, there is that huge culture clash. And people say they want to stay on, people say they want to stay on, within the organization as an MD or kind of running the acquisition independently. And then the bank doesn't understand that to be a founder of a fintech, you work very, very differently, perhaps to be the CEO of a bank. In this case, it has been suggested that there are kind of probably likely similarities between those two, whether it's personalities or whether, at least the fact that that's got them to that point that they're founding large financial services organizations. So I think that's probably where kind of the talk about it being quite a good fit has come from. I think there is always a danger. Something big buys something small, it gets swallowed up. I think Ziad touched very pertinently on the point about regulation. Fintechs do tend to do things faster, perhaps with a slightly greater risk appetite. Large financial services organizations generally have a much lower risk appetite, and that could completely get in the way of kind of a lot of the innovation and speed and drive that has made the fintech a success to this point. So that's something to watch out for. I can't speak to Capital One particularly on that point. I know that they've recently acquired Discover as well. They seem to be on something of an acquisition spree. Discover perhaps more closely aligned to their initial culture, being as a US card issuer. So I think it's going to be interesting to see. I think there's probably hope that the acquisition will work culturally, not least because they've been told that they continue to operate independently. Brex. The one thing that is interesting, and I sort of was aware of this, but hadn't realised quite what an issue it might be until I posted on LinkedIn. And my LinkedIn post hit an audience I have never hit before. And that was a lot of people in the US who are very, very angry at Capital One. And this is to do with the lawsuit that the CFPB filed against Capital One last year for cheating its customers out of $2 billion in interest. So that's the CFPB, a US regulator, suing the credit card issuer for withholding funds from its own customers. And I got all these comments on my LinkedIn post from all these angry people in the US, and I had no idea what was going on. I was aware of the lawsuit. I wasn't aware how many people had personally been impacted and how many people thought that I was defending Capital One when I had no idea what was going on. But, just to the point about culture, that may be an issue if Capital One has got a lot of angry customers. Now, a lot of those are retail customers. Brex serves businesses. There's obviously a disconnect there. But the point being, if the public perception of the Capital One brand is currently negative, how will that reflect on Brex? And will Brex's customers go, we don't want to be associated with that? So probably less a cultural point, more a brand point, but certainly something that I wasn't aware of until I started looking into this story, or rather until this story started coming to me.
Indeed. Well, it's a great point to end on. We've got no more time for this story. So really, really interesting deal. And I think you make a great point that the relationship between Richard Fairbank and Pedro Franceschi will probably have a big bearing on how successful that deal is. So let's move on to our next story, which is that Vennre has raised $9.5 million in pre-Series A to redefine private market access in the Middle East and North Africa. So Vennre, which is a wealth creation platform enabling high earners who are not rich yet to access private market opportunities, has announced the successful close of its pre-Series A funding round, raising $9.6 million. Vennre's mission is to democratize access to curated private investments for high-income retail investors in the Gulf Cooperation Council markets. By bypassing the traditional gatekeepers, Vennre offers a transparent, Sharia-compliant solution previously available only to institutions and ultra-wealthy participants. So looking ahead, Vennre plans to deploy this capital to grow its client network, launch new platform features, and deepen its presence in the Kingdom of Saudi Arabia. Ziad, so many congratulations to you and your team on the raise. It's fantastic news. What can you tell us about it, sort of beyond the sort of summary I just read out? This is fantastic news, correct?
Yeah, absolutely. Thank you very much. I think what I can tell you about it, that it wasn't easy. Let's be honest and transparent. And I think if any founder comes on your show and tell you, yeah, it was so easy, it's like either he's bluffing or he's into something else. I think just for clarity as well, if you allow me, $9.6 million is not all equity. It's a combination of debt and equity, just for transparency, because it's very important to highlight this. Look, we in our story, we came to set up out of the UK and get FCE coverage, get access to. So I'm an immigrant founder myself, and Anas Al-Halabi, my co-founder, and we came with a vision that we start out of the UK to build really a fintech that can solve a serious problem. Starting in the region where we come originally from. I'm originally Lebanese, Anas is originally Syrian, and Abdurrahman is Saudi. So we are three founders from the region, from the MENA region. We grew there. We had our professional experience there, so we have a very strong network, and we really saw a challenge ourselves as individuals. We were locked out from opportunities where we can grow our wealth, like institutional investors or family offices that we worked for in the past. And then as well, if you add the layer of the Sharia compliance, it's another complexity, to be very frank with you. Sharia compliant, some people, for them, it's binary, 0-1. You either invest in Sharia compliant or not. So it's not like optional. And we really wanted to solve the depth of this problem. The depth of it is not only, I wrote about democratization 2.0. Democratization 2.0 is more about a wealth journey, not just a deal on a platform that you can subscribe to and add it to your portfolio. Because if you don't see if that deal is suitable for you and how it fits in your portfolio, then it's another platform. And that's what we are definitely avoiding doing. We want to provide a wealth journey, starting with the private market, which is most difficult to access, especially cross-border from the region to US, UK, Western Europe. And as well, the cross-border is coming the other way. We launched a real estate project in Mecca, Saudi Arabia. We got access to a startup out of the region and their Series B and beyond. So it's a two ways cross-border. Overall, the round is helping us and should help us in three main things: accelerate our tech and product capabilities and integrations, and as well developing features that distinguish us from just being another investment or deal platform. Two is to grow our client base and deepen our presence in Saudi Arabia. The round is constructed in a way where the two co-lead of the round are ANB Capital. ANB Capital, for those who don't know, is Arab National Bank, one of the biggest banks in Saudi Arabia. Their capital arms had ANB Seed. It's a corporate venture capital that invests only in fintech. Along Vision Ventures. Vision Ventures is one of the oldest VC in the region, especially in Saudi Arabia, that backed many unicorns. And we're very delighted to have both, because we're getting the financial institution slash arm, and then a typical VC, but very as well successful, with participation of Sanabel 500, Ace & Co, and the Plus VC. In addition to many individual investors who are angels, but for us they are not. I think it's a mix. It's not like friends and family. It's strategic individuals that would contribute to your business, because building such a business is not a linear thing. It's very complex, and you need to tap into a lot of expertise. So this is a milestone for us, but it's not honestly the objective. The objective is how we use the money and what we do with it to grow the business, because then eventually, and after a certain period, I always say, like, in startup, it's like you are playing in a football league. You go from one league to another, but as you go to the more advanced league, you need to show more muscles and more skills and more capabilities. But what is at the core of what we are doing is that growing our Henry's communities, providing them service and access to create and vetted opportunities that were really unavailable for them in ticket size from $5,000 and above, and allowing them to build a portfolio in an informed way rather than here and there. So, and we want to move the journey of the investor to be able to allocate across savings, income, and the growth, in addition to a liquidity feature. So this is what we are working on. This is why we raised this money. And
Fabulous. Matt, I'd love to bring you in on this as well. Private markets have been notoriously hard to access for retail investors and private investors and so on, and very much it's sort of exclusively institutional, almost exclusively institutional all around the world. How much have sort of retail investors or private investors been missing out by not being able to sort of access those deals? Does it matter? Is it important for investors to be able to have those opportunities?
Absolutely. And it's one of the four pillars of Sidekick. So much of what Ziad was saying just resonates massively. At Sidekick, we have four pillars, which is cash management, public markets, private markets, and Lombard lending. So yeah, absolutely. It's one of our four, because we believe that going back to like the mission of the business, there are so many unfair advantages that you get as both an institutional investor or an ultra high net worth. And the beauty of public markets is clearly liquidity and, instruments you're familiar with, ease of access, all of those good things. But the benefits that private markets can bring, it can be a great diversifier. So, there is significantly less correlation between public markets and private markets when different macro environments play out. Liquidity is obviously one of the big challenges. And Ziad, I'd love to chat how you're solving the liquidity side of things as well, because that's something that we're looking at, and I can tell you a bit more about one of the products that we offer. But liquidity is often a challenge, but it also enables you to take a long-term view on things as well. So we're huge believers that private markets can and should, for the right investor with the right risk appetite, play a really key role to smooth out, take a longer term perspective, capture great returns. But it isn't about absolute returns on a standalone basis. It's about how they can complement the other things in your portfolio to ultimately go and achieve what you need to do, which is great risk adjusted returns over a long period of time.
I can certainly see you two continuing to exchange notes in the future.
It can become the private markets show. It's all right.
Sarah, what do you think of this? How exciting is it for investors to be able to access private markets? What do you think?
Yeah, I mean, I am not going to even pretend to have anywhere near the expertise of my two peers here. I think from the perspective of kind of somebody looking at what's available to retail investors and to individuals and consumers, more variety and more choice is generally a good thing if it is presented and accessed in a responsible way. So I think we've seen a lot recently about kind of, and in fact, I don't know if anybody, this is a slight tangent, but not that much of a tangent, if anybody's seen the most recent FCA advert with the seal. If you haven't, please get on YouTube and watch it.
Brilliant.
It's actually brilliant. It's utterly ridiculous. It involves the seal. And that's all I'll say, but please go and YouTube it. But the point it's making is a very valid one. And there's an awful lot out there and sort of capitalizing on the fact that a lot of people are struggling at the moment, and capitalizing on that and saying this is a really good way to get rich quick. And, a lot of them are not legitimate and are scams. Now, I'm not for the slightest suggesting that anything we've talked about today is that. But my point is that one of the things I think that fintechs working in this space at the moment need to do and really need to focus on is talking to people and presenting themselves in such a way that ensures the people who are using their services fully understand them, fully understand what it is you're doing, what the benefits are, what the potential risks are, because there are going to be risks in this kind of investment. That's just a fact. So I think the most important thing for me is choice is good. Absolutely, it's good to have options out there. But I think there is a sort of responsibility on the people providing these services as well as the regulators to make sure that people understand what it is they're doing. And as has been said, you need a balanced portfolio. You need to understand what you're investing could be lost. You need to understand that before you make the decision to do it. That doesn't mean we should be all doom and gloom and say, don't do it, it's not safe, because there are definite upsides to doing it, but it's just presenting it in the right way. And that's always going to be my perspective on this kind of thing whenever we see any kind of, new investment product or service come to market.
Yeah,
I hope I haven't offended either of you gentlemen, because that was not meant to target either of you.
I think it's such an important point, because I couldn't agree more on both the upside and the downside. So I think, one of the biggest barriers from a market perspective with private markets is lack of education, lack of knowledge, lack of familiarity. And I think, from both understanding the risks, absolutely, these are much more complicated products. I think we all as an industry have a job to do to explain the benefits, the risks, the characteristics, all that type of stuff. But I also think, I would love to hear what it's like in the GCC, but in the UK, this is so new. And new often means scary. New often means just tomorrow, not today. And, and I think we see so many opportunities on the upside if you can unlock some of these products. But the market is not going to get unlocked unless we educate, unless we really lift the lid on what it means, unless we really, to be honest, help bring it to life. Because public markets, obviously, there's generations of knowledge. And even then, the average retail investor is often not equipped to make good investment decisions. These products are brand new, so we have kind of an extra challenging job on our hands. But to even kind of catalyze the space in the first place, let alone also then trying to help educate around the risk side as well.
Thank you. Ziad, one last very quick question to you. You mentioned, as you were talking, that one of the big things Vennre does is it's providing access to Sharia-compliant investments. And there'll be some people listening to this who don't quite know what that means or why that's important. Could you just give us a very quick summary of what makes an investment Sharia-compliant and why does that matter?
Absolutely. Thank you very much. And actually, one just last step about what Sarah and Matt were tapping into. This understanding the sophistication of the segment is very important, because if it's not one size fits all, or one type of opportunity fits all, or one type of allocation, and the level of sophistication is a spectrum. So, and this is where technology should come, not only doing the education for everyone as if everyone needs the same education, but as well what kind of education journey they can have. And as much as they can be empowered to make their next investment decision, for us at Vennre, we've done an impact, even if it was now outside our platform. Even if people come to us and speak to us about something outside our platform, at least they are following a process rather than just they got a deal on WhatsApp and they want to subscribe to it. So going back to Benjamin, your point about the Sharia is obviously, it will be very difficult for me just to summarize it. It's a complex. It's people who follow the Islamic values. There are standards of how you do business, where at its core, interest rate is not something favorable, in a way where the whole purpose is to motivate people who hold cash to make their money being invested to create value in the economy and in the society, by not simply depositing their money in bank accounts and taking an advantage over the arbitrage of deposits versus lending, and taking interest fees and not investing their money in creating value or businesses or creating employment. That's the very basic intro to Sharia compliance. Secondly is what type of activity. So you cannot go into a Sharia, like a real estate retail complex that has a casino in it and then generate income from that casino, and then the underlying activity is not Sharia compliant. And actually, it might be surprising, but a lot of ethical investing or overlap with a lot of the Sharia compliance standards. Like if you want to follow, like you don't do arms, you don't do stuff that could be harming for the society and so on. But so it's not very far away if someone commits to ethical investing, actually. So the importance are two things: the underlying activity of the business, and two, how it is structured and how it is financed. Those are the two key things that define if an opportunity is Sharia compliant or not. So, for example, on a private credit side, we've been facing a challenge in bringing a private credit product that is really Sharia compliant, because some managers do something called wrapping, where it is like a plain vanilla private credit, but it's not really Sharia compliant. But so this is an area where you really need to make extra effort and innovate and find the right partner.
Thank you. That was an excellent summary. Well, thank you very much. And many, many congratulations again, Ziad, to you and your team. That's just fantastic news. So we will watch from the sidelines and wish you and your colleagues great success. Okay, well, we'll just take a quick pause here and we will be back very shortly.
Hey folks, David Breer here, CEO of 11FS. Here's something you might not know about me. I get a lot of people trying to impersonate me online, fake profiles, scam emails, the lot. And a big part of that comes from data brokers, hundreds of them, quietly collecting and selling your personal information, your phone number, email, home address, job title, all out there and all fueling identity theft, scam calls, and spam. If you've ever searched your own name online, hands up, who hasn't? You'll know how exposed you really are. That's why we've partnered with Incogni. They contact 230 plus data brokers and tell them to delete your information properly and legally under GDPR and CCPA. Doing it yourself would take hundreds of hours. Incogni automates the whole thing and keeps working with repeat removal requests if your data reappears. I tried it, and within days, saw brokers deleting my data. You can even protect your family members too. Fintech Insider listeners get 60% off an annual plan. Just head to incogni.com/fintechinsider and use code FintechInsider. And yes, it's risk-free with a 30-day money-back guarantee. You'll find the link in the description.
So now a quick break from the headlines to tell you about our latest Insights podcast. We've partnered with our friends at Pleo to look at how spend management has changed over the past decade, and with tools like artificial intelligence, what the next 10 years could look like. It's out now. Just head to the podcast below this one in your feed. Okay, let's go back to the news. So our next story is that JPMorgan has acquired WealthOS to bolster its pensions offering. So JPMorgan Chase has agreed to acquire the UK pensions technology firm WealthOS as it looks to deepen its retirement and personal investing offering. WealthOS was founded in 2019 and provides wealth and pensions software with teams based in the UK and in Sri Lanka. The deal was announced internally by JPMorgan Personal Investing, which was the business formerly known as Nutmeg, which JPMorgan acquired in 2021 for around £700 million. And while the financial terms of this deal haven't been disclosed, the bank says the acquisition gives it access to cutting-edge technology and deep sector expertise as it expands into wealth management. So Sarah, let's start with the sort of obvious question. What would a big American universal bank want with a British technology firm?
Well, I think at JPMorgan, by the way, every time I come on, I'm talking about JPMorgan recently. So I don't know if I've been put into that slot or if it's just that they're doing an awful lot of activity, and I'm sure it's probably the latter. So I think it's quite clear that JPMorgan has got the UK in its sights. If you look at Chase, the retail bank, you look at Nutmeg, this is kind of building on that strategy. If it wants to build in the UK, if it wants to expand in the UK, then, acquiring a company that's based here makes a lot of sense. It's quite likely that the teams at Nutmeg and the teams at WealthOS have come across each other previously. WealthOS has been around for sort of 6 or 7 years. It's had investment from Barclays, so it's certainly not a completely new kid on the block. It's got, established roots. So I think that'll make sense to go back to our previous story about culture. If they're going to try and merge two companies, then two companies that are based in the UK makes sense. I think there's also a point to be made about the fact that the UK has long led when it comes to pensions, full stop. I mean, the earliest pension I could find in British history was from 1590 for disabled seamen. So we've got a bit of pedigree there. Anybody who knows me would know that I could have gone down that rabbit hole for hours. But anyway, my point is British companies, the British financial services industry knows a lot about pensions. It's been doing it for a long time. And therefore, when people are coming along and developing cutting-edge solutions, or provide provisions or products for pensions in the United Kingdom, they know what they're doing because they've been here long enough to see all the problems. So yeah, I think it's a combination of, culturally it makes sense to buy where you want to expand, and also kind of the British pedigree and kind of the pensions market.
Now, the headline in Sky News for this story was that banking behemoth JPMorgan Nutmeg's rivals with purchase of WealthOS.
I couldn't believe they got away with that. You might have to explain to some listeners what that means.
So for listeners who are not British, the sort of term nutmeg is a sort of slightly rude way of sort of saying someone sort of headbutted someone. It's a sort of quite an aggressive term. Anyway, Matt, rather than forcing you to explain what nutmegs means in that context, do you think that Sky News is sort of right in suggesting that actually JPMorgan's pulled a bit of a fast one here because it's, here's the American bank picking out the British software company, and sort of by implication, Barclays is an investor in a number of other British wealth companies, British banks, etc., have sort of missed or passed up the opportunity. What do you think there's anything in that?
I take a really different view, and I'm obviously coming from a very biased perspective, building a wealth manager that's trying to disrupt the Nutmegs of the world, or the JPMorgan Personal Investing, the snappy title of the world. But if you look at that acquisition, which I don't know what it was, 3 years ago, perhaps, that they bought Nutmeg 3-4 years ago.
Yeah, 4, I think, possibly even 5.
Yeah, I mean, it was a huge business at that point. They'd done a very, very good job, but Nutmeg is pretty old. It was one of the early challenges within fintech. So, I'm sure infrastructure-wise, I'm sure technology-wise, that was not bleeding edge by any means. And, if you look at the product set that they offered, obviously it's improved over time and they've done what they've done very well. But challengers, I put ourselves in that space, have definitely moved at a pace with far fewer resources across a broader set of products and have innovated much faster. So, I'm second guessing here a little bit, but part of what I would expect would have been part of the investment rationale or the acquisition rationale would be, look, we bought this thing, it's pretty big, but it does a core really well. There's now all these new entrants running and actually potentially here to steal our lunch. We need a better technology stack to be able to go and enable some of that. So I really wouldn't be surprised if that was part of it, that they were just wanting to upgrade and perhaps didn't have the technology they were expecting with Nutmeg. The other side of it, and it's always hard to guess, right? Particularly when an acquisition, the amount isn't announced and things like that. But, I was a VC for a few years and invested in infrastructure players. And they are hard businesses because they are failing until they're not. You can build the most amazing technology.
Yeah.
And it can take you 2 years to sign your first client. And it can take you another 2 years before you sign your next one. It can take you 10 years before all of a sudden you are a huge business because of those enterprise sales cycles. So I'm sure WealthOS has some fantastic technology. And I'm sure that actually it was just waiting to be picked up by someone like JPMorgan and, potentially didn't have the contracts, to go and fly on its own. So you never know. The devil is always in the detail on that. But it does seem like a very good marriage, to be honest, to tie those two things together. And, it's certainly something we'll be looking at because I think, JPMorgan has definitely said that they want to get much broader into that wealth management space, do a much richer service beyond their core classic robo type offering. And it seems a good platform to be able to go and enable some of that stuff.
Ziad, thank you, Matt. Ziad, what do you think? Is pensions just a logical extension from investing? It seems that way. Do you think Matt's right? There's probably a technology play in here as well. What's your view?
So if you want to look at it, Nutmeg versus WealthOS, Nutmeg was a front business like to customer, while WealthOS, like an average retail, wouldn't know about it. That's why the tendency of Matt is to analyze that they wanted a technology that probably plug in well to their JPMorgan person investing, and they want to leverage this technology. It might be a good deal for JPMorgan. They got it at a good price where, honestly, again, we don't know the value of the transaction. We don't know those numbers. So it might be not as a strategic, but more of a good deal, because they are not acquiring customers. They are acquiring the operating system. In general, pension is a good introduction to reach people. Like if you wanna build a relationship with people, pension could be a good introduction. For example, in our region, in GCC, I know I'm in London, I live in London, but I say in our region, it's a bit weird. But we don't have proper pension systems like here. So and while pension here could be a very good starter to build a relationship with the retail customer, because the retail customer is most probably employed, they have a pension, and they are enrolled in a pension, they contributed their pension, you guys have the ISAs, and that could be a good starter to build a wider network. So getting access to probably data, insights that today JPMorgan doesn't have it for whatever reason. There could be a value out of it. We don't know. And I think the core point that this is not a front end product or a startup or a fintech.
It's pretty interesting, isn't it? Saying JPMorgan sort of moving into other layers into the stack, moving into the infrastructure layer. There's an interesting question of whether is this just about JPMorgan using this internally, or will they continue to support this business, offering the capabilities out to lots of other companies, which is, not necessarily a huge departure for JPMorgan, but it's definitely a sort of shift to providing more capabilities as a service than it perhaps currently does. I'm not really sure I'm throwing that question towards anyone. Matt, maybe final thoughts on this?
Really surprised. I'd be really surprised if that was it. Honestly, I'd be really, really surprised if they started to get into the infrastructure, as an internet infrastructure as a service layer. Um, no, no, I keep calling them nutmeg. I still can't adapt to JPMorgan personal investing. JPMorgan personal investing already does pensions as well. So, I think that's one of the interesting bits, which is at Sidekick, we're looking at launching a pension this year. And compared to the other areas, compared to an ISA, compared to a GIA, it is complex, it is hard, it is messy, it is manual. Kind of said it before, I think like they've got some slick tech. If they're making it nice and easy, I'm sure there's a bunch of costs that they can take out of that business. And, Nutmeg was loss-making. I think it remains to be loss-making. So anything they can do to turn that business around, I think has to be a good thing.
Very interesting. Okay, let's move to our last story of the week, our last big story of the week, which is that ClearScore is entering mortgages via the acquisition of Acre Platforms. So ClearScore has acquired mortgage technology firm Acre Platforms, marking its entry into the mortgage market. ClearScore says the deal lets it route mortgage demand from its 16 million UK users into Acre's broader ecosystem. The acquisition adds property, mortgage, and affordability data to ClearScore's platform, expanding beyond its existing unsecured credit and auto finance. ClearScore plans to roll out the mortgage platform internationally, starting with mostly English-speaking markets, including South Africa, Australia, New Zealand, and Canada. So, Sarah, maybe I can come to you first. For listeners who are maybe not aware of ClearScore, kind of what does ClearScore do, and what do you think Acre Platforms maybe adds to that?
So ClearScore is probably most widely known in the UK as being a little like an Experian or something like that, where you can go and check your credit score. What it also does off the back of that, like many similar platforms, is offer credit products to customers. So you can go on there and you can find kind of the most, appropriate credit card or car loan, and therefore now apparently mortgages. So there's a logic to that. That if ClearScore is expanding its product offering into other forms of credit for individuals and for consumers, then it would look at mortgages as well. Acre is an interesting company to me because it's an alumnus of the Venture Studio where I used to work, Founders Factory. So I'm really actually quite pleased to see this. This is quite nice for me to see as a story. So I think there's logic to it from ClearScore's perspective. Acre is it's quite a broad platform itself. So if ClearScore is kind of consumer-facing, credit scores, credit products, Acre is very much on the back end doing all sorts of interesting things for mortgages. Why I say interesting? They're probably interesting to people in the mortgage space. The consumers are probably less interested. But what they do is they're a digital intermediary solution for brokers. They do have a digital interface for clients. So the end client trying to get the mortgage can then kind of see where they are in the process. They can interact with kind of their broker. They also have a solution for kind of the mortgage managers, so they can keep an eye on, for example, keeping track of whether customers are becoming vulnerable, missing payments, in accordance with, various FCA regulations. So Acre does quite a lot. I think it's quite a comprehensive solution. I think it fits with ClearScore's platforms. My question is, ClearScore plans to roll out the mortgage platform internationally, starting with South Africa, Australia, New Zealand, and Canada. Now, mortgages between Scotland and England are completely different. So I have questions about how, I'm not saying they can't do it, and I actually don't know. All of those countries I just mentioned are ex-Commonwealth countries. It's possible they have similar mortgage systems to here in the UK, but mortgages are almost as bad as pensions for being complicated and having a lot of backwards processes involved. So I'd be really interested to see how they plan to roll out a mortgage offering overseas.
Yeah, I was going to say, Matt, you were just talking about how complicated pensions are. I mean, mortgages is another area of enormous complexity, long-term products with lots of still sort of paper processes around the place and so on. It feels like it's a similar sort of business to WealthOS in some respects, and similar, so presumably facing similar challenges.
Yeah, I mean, it seems like a great tie-up, to be perfectly honest. I mean, as you say, that it is such a fragmented system. It is still a very offline system. There've been plenty of players who tried to disrupt it and have found how hard it is as well. So, I think if there is a natural technology partner that that can just help them capitalize on that space. It just feels like a really good opportunity. I mean, mortgages, I feel like a bit of a holy grail as well for ClearScore. If you're thinking about commissions that they can take, commission you could take on a credit card might be in the tens of pounds, I'm sure.
Mm-hmm.
Commissions you can take on a personal loan maybe in the low hundreds, but commission I'm sure you can take on a mortgage is significantly higher. So if they can do that, productize it, work with a partner to digitize it and scale it ultimately, I think that could be absolutely huge. I think the bit I don't know about Acre is the other side. So, do they have all the relationships with all the mortgage brokers in each of those different locations? Because if they have, I mean, then that is how you go international on day one. If they've already got that network, they're having to build the network from scratch. That's a whole other beast. But I'm sure that is. I'll dig into Acre in a lot more detail because it looks a really, really interesting deal.
Great perspective. Ziad, have you thought about sort of mortgages at Vennre? Because obviously, lots of people around the world, in the Gulf region, but all around the world, put a lot of their money into property, particularly for their sort of primary home. Have you sort of started thinking about sort of mortgages and how you might sort of weave mortgages in with some of the other things you do, or property investments more widely?
To be frank, no. Very straightforward. I will tell you, first of all, it's a very complex field. It's very vertical. I think what we see here that ClearScore is getting into Acres, probably they want to grow vertically into that space. And about the cross-border, I'm sure there are a lot of challenges. As Sarah mentioned, cross-border, anything cross-border is really a challenge. And I'm not sure if this plan to roll out through all the countries listed by when eventually. So, but buying a home is an important topic for Henrys. Let's put it this way. And Henrys care about if they haven't bought real estate, especially in our region where real asset matters a lot. Historically and culturally, there is a saying in Arabic, like real estate is the good son of your investment. So I just try to translate it now.
Mm-hmm.
So people grow up saying they want to buy their first land or their first house, or we come across those questions from the Henrys, like when is the right timing to buy a home, or when they need it, and how much for how long they need to lock in their money and capital, and it depends on how the market are moving, and if the Henrys are working in the GCC but they are not originally from there. There are a lot of dynamics. And before, just now, Saudi Arabia announced allowing foreign nationals to acquire real estate properties in Saudi Arabia, and that's a big transition because before you can live in Saudi Arabia for 10-15 years, but there is no law that allow you to acquire your home. So expats from Levant area and North Africa used to end up buying homes back in their original countries like Egypt, Lebanon, Syria, and so on. So it is an important topic. Like when it comes very common among Henrys, and about the timing, about the size. Like honestly speaking, we've advised many people about like just how to define the timing, like not whether to buy or not to buy, but when to find the right timing and the right size of the opportunity as well, or the home, because some people try to aim so high and that would suck all their cash, and they sit and keep on working to pay the mortgage, and they cannot grow a wealth out of it. And it's a very interesting topic, definitely. But for us at Vennre, not at this stage. Let us solve the issue of liquidity, maybe with Matt. We do it in the GCC. Matt does it here, and let's solve this. And I think the sky then is the limit.
So interesting. Thank you. All right, well, let's wish everyone at Acre Platforms and ClearScore the best of luck. Exciting deal, and best wishes to everyone involved, and hope for many good things in the future. So on that note, we'll take another quick pause here, and we will be back very shortly. Okay, now for a quick look at one story we don't have time to cover in full, which is that Revolut has dropped its US bank buyout plan and is instead eyeing a standalone Office of the Comptroller of the Currency, or OCC, charter. So Revolut is rethinking its American strategy, dropping plans to buy an American bank and instead preparing to pursue a standalone US banking license or charter. According to the Financial Times, Revolut has been in discussions with American regulators about applying for a national charter via the Office of the Comptroller of the Currency, or OCC, which would allow it to operate across all 50 United States. The move marks a reversal from last year, when Revolut explored buying an American bank as a shortcut, a route it reportedly cooled on due to regulatory complexity and expectations around physical branches. So, this is an interesting story. Poor old Revolut does seem to come up a lot with license challenges, but it makes sense. It makes sense to get its own license rather than sort of trying to back into an existing license, which may indeed have expectations around branches and so on. Not that having the odd branch isn't a bad thing, because psychologically, customers seem to be more comfortable depositing money in a place that has a physical presence. But nevertheless, this is an interesting decision, and best of luck to Revolut that that's a smooth process, because one of the challenges for digital banks expanding into the United States, whether they're American, homegrown, or from overseas like Revolut, is the sheer difficulty of getting a charter or a license and the cost and complexity of that process, which in some ways has slowed down the arrival of fully fledged digital banks into the United States. Okay, and finally, one more weird story which has taken the internet by storm this week, which is that a deer has caused chaos after crashing through a bank window as the police are called to the scene. So police in Suffolk County, New York, were called to a Webster Bank branch after an alarm went off for a suspected burglary, only to find that a deer had smashed through a window and was tearing up the office, trying to escape. Officers eventually managed to lasso the deer and guide it safely back outside. And yes, the police confirmed that the deer was not charged and lives to break into another bank another day. So, firstly, Sarah, you've clearly been watching videos on YouTube this week. Have you seen this particular video?
Animal-related videos on YouTube. Who knew? I need a break from the real world, guys. I have actually seen this. That will serve to be on LinkedIn. My first thought was, oh, that poor deer, because it does look in distinct distress, though it does sound like the deer was safely rescued and returned to the wild. My second thought was, if a deer can break in, who else can break into this branch? And are they looking closely at their security?
Matt, if you're sort of Webster's social media manager, what do you think? Is this an opportunity? Or maybe it's, as Sarah points out, it's an opportunity to attract criminals. But is there a fun way the bank can make some publicity out of this? Do we think?
Almost certainly. I mean, the fact that we're talking about it on the other side of the Atlantic, there's no bull in a china shop. It's here in a bank branch. So I'm sure you can make some sort of saying out of that and make it stick. So yeah, I'd be doing that if I was a social media person.
Brilliant. The other question our producers have lined up is about fictional bank heist movies. And I'm not sure there's that many films with a fictional sort of animal-based robbery. But the one they've come up with is Feathers McGraw from the Wallace and Gromit films. I don't know if those have had much circulation beyond the UK, but there's a penguin who famously puts a sort of rubber hat on his head and looks a bit like a chicken and disguises himself.
Can I just say that the last time I was on, the last story was about a bank heist as well. So I don't know if there's a theme here, if bank heists happen more in the winter, but...
I always remember the American bank robber who was asked, why do you keep robbing banks? And he said, well, it's because it's where the money is.
Just leave it there.
I think there should be an opportunity for more companies that does security windows to market that the bank was taking cheap option. So this is where the opportunity is.
Definitely. Deer-proof windows. All right. Well, the three of you have been the most fabulous guests. Thank you so much to the three of you. Where can people find out a little bit more about you and your companies? Firstly, Sarah, where can people find out a little bit more about you and what you're up to?
You can find me on LinkedIn at Sarah Kocianski.
Matthew, where can people find out more about you and about Sidekick?
They can find me on LinkedIn, so Matthew Ford, but importantly, Sidekick, go to sidekickmoney.com or to the App Store or Play Store and just search for Sidekick Money.
And Ziad, where can people find out more about you and about Vennre?
Yeah, it's LinkedIn, Ziad Mabsout, Instagram, Ziad Mabsout. I share more stuff there behind the scenes and less professional, more real. And obviously at the website and our mobile app, if you want to explore what we are doing, this is a place.
And as for me, Benjamin Ensor, you can find me on LinkedIn, and you won't be able to find any behind-the-scenes footage of me on Instagram because that would be very dull. Right. Well, that wraps up today's episode. Thank you all so much for listening to today's show. If you enjoyed what you heard, please do recommend us to your friends. Do follow us on your favorite podcast platform. And do share a review if you wish. If you want to join the conversation, seek us out on social media. Just search for 11FS or Fintech Insider, or you can email us at podcasts@11fs.com. Thank you all again, and goodbye.
Retail investment in the UK is the lowest in the G7. According to the Bank of England, there is over £280 billion sitting in UK accounts earning no interest. Something has to change. Financial firms in the UK must look at making investing accessible, contextual, and trusted through everyday platforms. That means bringing investment journeys to the point of need, alongside spending, saving, and budgeting, and within platforms that already play a meaningful role in customers' lives. We dive into this and more in our latest report, Taking Advantage of the Embedding Investing Opportunity, produced in association with Secor. Download your copy today at 11fs.com/embedded-investing.